The federal government is doing something unprecedented in the world of real estate. March 1st, 2026, mark it, because on that date, a rule called 31 CFR Part 1031.320 goes into effect. And if you're a real estate investor, I don't care if you have one duplex or a portfolio of 500 single-family homes, March 1st, 2026 is a date that's going to go down in history. It's the day the federal government officially removes real estate privacy. And if you are a cash buyer, a hard money buyer, a creative finance investor, a subject to guy, a seller finance guy, this affects you directly. Not maybe, not eventually, right now. See, as a tax strategist and real estate investor at keepmost.com, let's break this down the way we always do. No fluff, no fear mongering, just the facts, the implications. Let's get into it. So first, understand who's behind this. FinCEN, the Financial Crimes Enforcement Network, is the Treasury Department's financial crime unit. Their job is to track money laundering, sanction evasion, drug money, cartel cash, all of it. And for years, they've had a problem with U.S. residential real estate. Here's the problem as they see it. When you buy a house through a traditional bank, Wells Fargo, Chase, whoever, that bank has what's called an anti-money laundering program. They're already checking your identity, you're filing suspicious activity reports, and running compliance. And the government gets what it wants. There's a paper trail there. But when someone walks in with a bag of cash, metaphorically, or private money or hard money and buys a house through an LLC or a trust, historically, nobody was required to report who was actually behind that purchase. You could have a cartel leader in Mexico owning a dozen single-family homes in Phoenix through a Delaware LLC, and nobody in the federal government would know. And that's a real problem. And FinCEN has been saying it publicly for years. So this new rule is their answer. They're not trying to catch you, they're trying to close the anonymity loophole that bad actors have been exploiting for decades. But here's the thing, the rule doesn't care whether you're a cartel boss or a landlord in Ohio with 3 rentals, trying to protect yourself from frivolous lawsuits. If you trigger the rule, you have to report. So let's walk through the triggers. Trigger number 1 is residential real estate. We're talking 1 to 4 unit properties. These are single family homes, duplexes, triplexes, fourplexes, condos, co-ops, and vacant land intended for a 1 to 4 family build. Commercial property, not included. 5 units and above, not included. It's specifically targeting the residential space. Trigger number 2 is non-finance. This is where people get confused. You see, non-finance doesn't just mean cash. It means you did not get a loan from a bank or financial institution that is already required to run anti-money laundering programs. So cash? Yes. Hard money from a private lender? Yes. Seller financing when the seller carries a note? Yes. Subject to where you take over someone's existing mortgage? Yes. But if you close with a conventional mortgage from a regulated lender, you're not in the reporting zone because the bank is already doing compliance. Trigger number 3, the buyer is an entity or a trust, LLC, corporation, partnership, trust. If the deed goes to any of these structures and the first 2 triggers apply, you've got a reportable transaction. You see, all 3 of these triggers have to be true: residential, non-finance, and an entity or trust buyer. That's what we call the trifecta here that kicks this rule into gear. Now, you may be wondering, who is in charge of reporting? Well, you're probably not the one filing the report. You see, FinCEN uses a hierarchy of who's responsible for the filing. The first person in the closing pipeline who qualifies takes the responsibility. Usually, that's your title agent, your escrow company, or your closing attorney. They will file a real estate report with FinCEN within 30 days after the date of closing or by the last day of the month following the month of closing. And they need to collect certain information from you to do it. So what information? Beneficial ownership. You see, FinCEN doesn't care that the buyer is 123 Main Street Holdings LLC. They want to know who is behind that LLC. That means your name, your date of birth, your home address, citizenship, and taxpayer ID. For trusts, they're looking at trustees and beneficiaries. They also collect the basics, right? Purchase price, how it was paid, and the source of the funds. You see, the report and supporting documents must be kept for 5 years. And here's something that's worth emphasizing. This information is not public record. It goes into FinCEN's database. It's not searchable on a county recorder website. Your tenants can't find it. Plaintiff attorneys can't subpoena it without a federal process. So your public anonymity from the world, that's still achievable. But what FinCEN is ending is government anonymity. The feds want to know who you are. Now, here's where the thing gets interesting because there's a real play here. You see, the regulation itself carved out a specific exemption, and it lines up almost perfectly with how sophisticated real estate investors are already structuring deals. The exemption is a transfer for no consideration from an individual to a trust where that individual is the grantor or settlor of that trust. So, in plain English, if you personally buy the property first, then transfer it into your own land trust, where you are the one who created and funded the trust, that second transfer is exempt from reporting. No filing required. So here's the sequence that actually works in the new environment. Step 1, you acquire the property in your personal name. Cash, hard money, whatever. Your name goes on the deed. Step 2, you transfer it into a land trust where you're the grantor and beneficiary. That transfer is exempt. No FinCEN report. Step 3, you assign your beneficial interest from the land trust to your LLC. You see, that assignment is also not tracked under this rule because FinCEN is only capturing the real estate deed transfer and not beneficial interest assignments. So the end result is that your LLC effectively owns the property for asset protection purposes. A Wyoming LLC as a trustee keeps your name off of public records going forward. And with that, you've complied with the spirit of what FinCEN is asking for. Because when you closed in your own name, you gave them the identity link they were looking for. It's not a loophole in the shady sense, it's operating in alignment with the purpose of the rule. FinCEN gets their transparency, you get your protection structure, and that's the loophole here. Now, let's look at the penalties. You see, negligent violations can cost up to $1,400 per day, with up to $111,000 for patterns of neglect. And willful violations may lead to $250,000 in criminal fines or 5 years in prison. So I want to show you guys what's at stake. If you willfully fail to report here, we're talking $278,000 per violation. And it's not just civil, right? It's criminal too, up to 5 years. Think about that. You flip 5 houses next year. You don't file the paperwork because you didn't know. And suddenly you're looking at $1 million in fines and 25 years in the feds. Is that a risk that you're willing to take? And one more thing for subject to investors specifically. The moment FinCEN starts collecting this data on non-finance transfers, it's only a matter of time before banks start cross-referencing it. Banks could theoretically start identifying properties where the underlying borrower is no longer the owner, which is exactly what triggers the due on sale clause that every subject to investor has been quietly navigating around for years. This regulation could become the back door through which the banks finally start blowing up those deals. And that's a realistic downstream consequence to plan for. If you're a real estate investor, you need to be talking to your title company today, because the cascade of reporting means if you don't file, the title agent has to. And if they're scared of the federal government, they're going to over-report everything. They'll give the feds your blood type if they have to. So let's zoom out for a second. Why is this happening in 2026? We're seeing a global push for beneficial ownership transparency. They want to know who owns the land. They want to know where the money is. This isn't just about catching bad guys, right? This is about data. If the government knows every parcel of land linked to your social security number, they have a roadmap for future potential wealth tax. They have a roadmap for future regulation. Heck, it could be the great reset of property rights. Here's what you need to do before March 1st. Number 1 is audit your portfolio. Any residential property held in an LLC that you plan to move or sell, get it done now. Number 2, clean up your buying flow. If you're a cash buyer, stop closing directly in the LLC name if you want to avoid the FinCEN report. Number 3, learn the land trust. It is the bridge, right, that keeps you compliant while maintaining your anonymity from the public. Number 4, talk to your title agent. Make sure they understand the exemptions. Don't let them report you unnecessarily. Hopefully that helps. Make sure you like this video, right? It truly helps it to reach more people. And subscribe to the channel. My name is Keran, and I'll see you in the next video. Take care.